Pretty much all the above. So interest rates, there were, a lot of people, including ourselves, bought deals on floating rate debt. Bridge loans, a lot of advantages to it and some disadvantages to it, right? And, a stat I saw, whether it's, verified or not, 96% of syndicated deals during that period of time were floating rate debt, right?
Mm.
So a lot of people got into that position. Rates ticked up from, the fours to 11.5+%. We had properties that, no joke, the mortgage payment tripled.
Whoa.
You can't really pay your mortgage, right?
Yeah.
We've had properties, if you're not a cap rate, but a rate cap, which is interest rate protection, you can buy, think of it as an insurance policy of how high your rate can go up. And you can buy this little policy that went up over 3,400% in less than 2 years.
Welcome to the Real Estate Pros Show, where we interview real estate investing professionals from coast to coast, as well as the service providers that serve the real estate investing industry. Our goal is simple: share what's working now to help you improve and scale your business to the next level and meet the pros that can help you get there. Real Estate Pros is powered by Investor Fuel, America's leader in helping real estate investors and professionals build the business you need to live the life you've always dreamed of. Let's start today's show. Property insurance for real estate investors doesn't have to be difficult, but it does need to be there to protect you when you need it. MyInvestorInsurance.com not only provides insurance at 15 to 30% cheaper than traditional agencies, it's built specifically for real estate investors like you. You can set up an account in about 2 minutes, get quotes on properties, turn on and turn off insurance for your fix and flip or rental properties in around 2 minutes without having to talk to anyone directly, all through our portal. There's no better way or faster way to make sure you've got the coverage you need to protect you, and no more lengthy policies either. Once you're set up, you're billed monthly and prorated by the day for however long your policy is active. It's powered by MSI, the third largest independent MGA, with 1.5 million customers and more than $1 billion in cumulative premiums written. Get set up today in about 2 minutes at myinvestorinsurance.com/fuel.
Hey folks, welcome back to the show. Today's guest, Mark Kenney, is a seasoned real estate investor, entrepreneur, and founder of Think Multifamily. He has extensive experience in property valuation, acquisition, and operations based out of Dallas. Mark, welcome to the show.
Thanks for having me. I really appreciate it.
It's great to have you on here. I always like to start off at the top of this show, Mark, by asking guests how they got started in real estate.
So I started smaller multifamily, 2 to 4 units over 30 years ago with I have an identical twin brother, and we were in college, seniors, and we're like, hey, what are we going to do? Right. We need to buy some real estate. I don't really even know how we frankly got into it, other than we thought it made sense. People need a place to live. We didn't have anyone in our family doing it or anything like that. Bought our first property as a 2-unit when we were 21 years old. And started buying smaller properties, 2 to 4 units for a while as a CPA. I worked for the Big Four consulting as well, management consulting, IT company I started in 2013. A friend of mine was doing a syndication in a little bit larger multifamily. I think it was like 116 doors. And I'm like, hey, it kind of makes sense, and invested in that, and then invested in 2 other multifamily deals. And my wife and I are kind of like, we think we could do this too. And 2015 is when we syndicated our first deal and kind of went off to the races after that.
So I want to talk about 21, getting into that first multifamily property with your brother. Did you think at that point in time, hey, we're going to be real estate investors, or were you thinking, hey, we need a place to live and this could be, a potential way for us to maybe have where we're lived paid for?
Yeah, so we didn't live in that one. We knew everyone needed a place to live. It was real estate investor for sure, but never really, even if you want to say, thought about buying 100+ units. It was like, let's buy 2 to 4 units. Turned out we were kind of the landlord, actively involved, maintenance people, stuff like that. We were both working 80+ hours a week at the Big Four consulting, coming home 10, 11 o'clock at night and shoveling snow and doing, silly things like that. And, but no, never really dreamed about doing large properties. But we did say, hey, we're going to continue to buy, smaller properties and then hopefully use that as kind of a retirement thing. We've since sold all those properties, but yeah, one burned down actually. The last one we had, we bought when we were 21, actually burned down about 2 years ago. We had it on a land
Goodness.
contract, and I drove by it this 2 weeks ago in Michigan when I was there, and it's empty lot now.
Stop living on an island and join the #1 mastermind in America for professional real estate investors. Investor Fuel is a community of hundreds of the nation's top investors working together to build stronger businesses and better lives. In addition to the amazing community of real estate investors acting as a board of advisors for one another, Investor Fuel members have access to 100% funding on purchase and repairs for our members only, a health insurance program, and benefits and discounts that more than pays for the membership of most of our members, meaning it's actually costing you money to not be a member of Investor Fuel. If you're looking to scale your business and build a business that allows you to live the life of your dreams, please visit investorfuel.com today and book a call with our team.
Yeah. When did the syndication, I wouldn't say craze, but when did you start to see more and more syndications happening to where it was on your radar? Hey, this is something that, other people are doing. I'm seeing more and more of this. Maybe we should start to do something like this.
2013 is when we first saw it. We had a friend doing it. He invited us to an event. I went the first time to the event. My wife was out of town. Second time she went there, and we're like, hey, this kind of makes sense. And we both really loved real estate, for whatever reason. I think a lot of things you're just born with, you don't control it. It's just born. And we're like, hey, it makes sense. So 13 is when we started investing passively. And then 15 is when we started looking for deals and did our first syndicated deal.
Walk me through that one. So you're in Dallas. Are you in Dallas at the time? Were you looking at on market, off market? How did you acquire that deal?
We were at Dallas at the time, and it was really trying to build relationships with brokers since we had never done a deal. It was 32 doors initially, which is smaller than we wanted, but I'm like, hey, we need to build relationships with brokers. The best way to do that is, don't go meet them for coffee, go meet them on a deal they're selling, because that's how they make their money.
Yeah.
So we toured the property, and the broker said, well, there's another 32 units right next door, like 200 feet away, that the same seller owns. He might be interested in selling those as well. So it ended up being 64 doors in total. Still a little smaller than we wanted, but it was, it was not bad. The raise was about $1 million. I was pretty much freaked out about that. I had never raised money before, was kind of almost like embarrassed asking even people to invest in deals. And but we did it. We ended up raising the capital for that, and closed on that deal, and actually just sold that one in 2025.
I want to talk about exit strategy. So at that point in time, I'm imagining syndications, while they were existing, were not what they are today. And I was talking to you before hopping on the show. It seems like everybody right now is either a syndicator, or they may have been a syndicator and maybe faced some troubles in the last couple of years. But at that point in time, 2013, 2015, that time period, were the syndicators having, 5-year exit strategies? Was it less structured, or has it evolved over time?
So the exit strategies were, kind of like, hey, 5 years as general. And then back in the day, during that time, we had a deal, like it was 16 months. We returned over 100% of the capital. It was just a different, market
Yeah.
back then. So the 5-year exits turned into like almost like who could deal with their money the fastest is what it turned out to be. Oh, 2 years. Oh, you suck, right? I'm tongue in cheek a little bit, right? But people were, went from 4 years to 3 to 2, and like we had, a few deals less than 2 years, doubling the money. So structure wise, I think it was very similar. It still had, private placement memorandums. The timeline ended up increasing a little bit as time went on to like maybe a 7-year versus a 5. There were less people, no doubt, involved really in syndication in 13 and 15. I would say probably like 18 to 22 is probably the peak of it.
Yeah.
It's where a lot of people, including ourselves, we bought a lot of deals, sold a lot of deals, and, ended up putting money back into deals in 2022 and 2021, which, as you mentioned, is a much different market. It's a much different market than it is, it was in, 10 years ago.
Yep.
But also a lot of lessons you can apply that, hey, never do that again, and how would I do things differently in the future?
If you're looking for consistent, high-quality leads, look no further than Investor Machine. Investor Machine isn't just another agency, it's the most sophisticated, data-driven lead generation company on the planet for real estate investors, and serves the role of being not just a lead generator for your business, but a marketing partner that is helping you achieve your goals along the way. Go to investormachine.com to learn more and schedule a call with our team today.
But
Right.
it was easy. You could almost do nothing on a property, and just by the cap rate compression, when that happens, it's dramatic of what that can do for a value. So unlike a 4 unit below, 5 units and above is a business, and every dollar you can increase your operating income is $15+ of value. Like, that's a real number. Someone will pay you $15 for every dollar. Pretty hard to achieve that other places, but it works the reverse. So
Right.
it goes down the same way.
When
So
when you were in that time period, I mean, you talking about seeing returns, you projecting 5 years, getting it in 2 years. At that point, it had to feel like, okay, we've kind of struck a gold mine here.
we struck a gold mine. You're a genius, right? How smart you're, until you're not, right?
Yeah.
It's timing of the market. Not that we tried to time the market, we didn't. It's luck. People, anyone that really is truly successful, there is luck involved. Luck involved. What family you're born into? Where did you
Sure.
move? There's certain things, and don't get me wrong, it takes action to do it. We could have sat there and done nothing, but yeah, I mean, we were like, man, we made it, dude. Like, this is like a dream come true, and until the nightmares start, which
Yep.
for us included, along with other people, started, in 2023, and it's gone on since then, and it's been difficult in some
I
cases.
want to pivot a bit here, Mark, and ask you about that specifically. You're really being the multifamily guy. I think you're the exact person I should be talking to about this, because I've been having people come on the show, some with lots of experience, some with almost no experience, but talking about there's distress on the operator side in multifamily across the country stemming from that 2020 time frame. I've heard people say things, it's arm rate loans. I've heard people say things, rents have gone down. There's too many people getting into the space. What happened?
Pretty much all the above. So interest rates, there were, a lot of people, including ourselves, bought deals on floating rate debt. Bridge loans, a lot of advantages to it and some disadvantages to it, right? And, a stat I saw, whether it's, verified or not, 96% of syndicated deals during that period of time were floating rate debt, right?
Right.
So a lot of people got into that position. Rates ticked up from, the fours to 11.5+%. We had properties that, no joke, the mortgage payment tripled.
Whoa.
You can't really pay your mortgage, right?
Yeah.
We've had properties, if you're not a cap rate, but a rate cap, which is interest rate protection, you can buy, think of it as an insurance policy of how high your rate can go up. And you can buy this little policy that went up over 3,400% in less than 2 years. So, $100,000 protection, if you want to say, to buy would cost you over $3.4 million of the lender saying, give me $3.3 million to renew your new rate cap,
Policy,
right?
yeah.
We had one property where insurance in the coastal area went from $600,000 a year. It's a little larger property. After 1 year to renew it, it went to $3.6 million. So, and a $3 million increase on insurance. You couple that with lenders that were also, you're trying to refinance your deal or extend your loan after 2 years, and the lenders, like, hey, we're going to rebalance your loan and
Yeah.
give us $5 million just to protect them, right?
Right. Right.
And then on top of that, you have evictions that were happening that were taking 16+ months. One city we're in had over 12,000 people on, backlogged on the
Yes.
eviction list. So there really wasn't one thing by itself. Property taxes skyrocketed in some areas, even though values were going down. But if you look at all those things and you're like, oh my gosh, like, why would I even get involved in multifamily? All these issues. Well, become smarter, wiser, if you want to say. You have my idea, you have knowledge, you have understanding, you have wisdom, right? now just what you know, you don't necessarily understand it. And then you
Right.
apply that and say, I understand it now. And then, okay, now I understand how to use that information to make wiser and better decisions in the future. So, 90% of all these issues in reality could have been, if you want to say, removed, eliminated. It would require you typically to make a little less return in theory and go slower. But, a lot of us, got caught during that period of time buying a lot of deals.
If you're a new or newer real estate investor looking to launch or grow your real estate investing business, please check out Investor Fuel Club. It's a coaching community, but unlike anything you've ever seen before. And you can actually partner with members of our mastermind from coast to coast on deals right in your market. There's no better opportunity to build a consistent business than to literally partner with pros to help you avoid costly mistakes, avoid the need for capital to do deals, and help you eliminate your fears as you're starting your business. Learn more about Investor Fuel Club at investorfuel.com/club.
I want to get a little bit granular here, Mark, maybe give away some of the gold, but not all of it here. For folks, 2020, of course, looking back and seeing what they did, maybe could have done things differently. You mentioned, the mortgage premium tripled on some properties. You mentioned evictions, and some compression overall in the market, maybe not appreciating as much as anticipated, or rent stabling off, or even going down. How could people have bought more, I don't want to say responsibly, but maybe bought with more caution? Would they have just made lower offers? Would they have secured different types of mortgages? What would be the answer?
Different types of deals, reality. So when people are like, heck, how can everyone be so stupid? Well, a lot of these deals that were value add deals, you can't go get a Fannie or a Freddie or HUD loan. It's not possible. They're not occupied enough. Those agencies also were giving basically nothing for CapEx. So we bought some deals that were, 0% occupied, 30% occupied, and $20,000+ a unit of CapEx. So your only option's bridge, that's really the only thing
Right.
you can do. So what you could do and what we do going forward would be like, hey, we'll look at deals that are stabilized, that will qualify for the fixed long-term debt. So you don't have that unpredictability. Avoid certain areas where insurance costs have gone, through the roof. We know we're in 15 states, so we know which, it's at the county level for evictions. We know which counties we'll never go back to ever again in my entire life. And there are just other, you're going to make a little bit lower return on those, which is harder because you're competing against people projecting probably 50% higher return that you're going to make. But I do think people are kind of realize that, hey, maybe this, the risk reward is better to have a little bit safer deal, a little bit lower, a lot lower risk in some cases and lower return. So looking at different deals, the debt, even understanding taxes,
Yeah.
structuring partnerships differently than a lot of the partnerships were structured, as far as who can do what and things like that. Location is huge. What properties and locations were oversupplied? What happened? We have a city we bought in, the cap rate. So value went down 41%. That's a true number. So whatever, $23 million deal went, decreased by $9 million of value in less than 2 years.
It seems kind of like a perfect storm of things that could go wrong. But on the other side too, it also seems like there's an opportunity for people, so because there's a distress on the operator side, but the properties themselves may be newer. Is there an opportunity for folks to come in and maybe make creative offers? Would sellers even be able to entertain that?
100%. There's no question those deals are out there. Volume starting to pick up a little bit. If you look at the deals, and I'm not, people have to make their own individual decisions, what types of deals, but there are deals where we looked at that are, you can invest in a deal where it's going to go from bridge, been owned for 3 years. That's on bridge debt. It's stabilized because not all these properties are distressed properties. They're distressed in a lot of cases due to debt.
Right.
So if you can move from 11.5% down to a sub 5% Fannie loan, which you can do right now, and the deal has been owned by somebody for 2-3 years, you come in with equity in those deals. It's like a lot of the unknowns are are already known. You know what the rents can go to, property taxes, insurance, all the hidden skeletons and CapEx is done. That's if you're going to come in and invest in a deal that's moving, same operator maybe, but moving from a bridge to, into like a Fannie or Freddie type deal. Buying brand new deals, there's no question values are down. You're going to be able to buy right now cheaper than you could have, 2, 3, 4 years ago, just reality. And if you buy a deal that can qualify for fixed long-term debt in an area that maybe doesn't have all the fluctuations with insurance, in an area where it's easier to evict. I mean, history tells you where those areas are,
Right.
and those type of things. And then, structure in that way to where a lot of the unknowns that, a lot of people got in trouble over, right,
Yeah.
are they're known now, and you're buying at a discount. It's just reality. In some cases, a pretty big discount.
Now, even though there's been this, I would say, tribulation or difficulty on the operator side, I'm still seeing multifamily properties go up everywhere in the country. And so, how is that still happening? How are there, and I understand that it's hard to get new developments in multifamily to pencil, from what I understand. So, how is there so much multifamily that's still going up everywhere?
Uh, I mean, it's definitely down from where it was in the prime. It's higher than it was, 6 months ago. But a lot of it is people being forced to sell their deal. They don't have a choice. The lender is saying, hey, we're not going to extend your loan. I actually just talked to someone last week. This is a 98% occupied property. They had it for 3 years, never missed a debt payment. And the lender's like, we're not going to actually extend your loan.
Really?
Yeah. I mean, it's just lenders do whatever they want, whenever they want, and be careful about different lenders. And that's probably a different podcast. But people are being forced, and then a lot of deals were sold on loan assumptions, which ourselves included. Sold a lot
Yeah.
of where someone else comes in, takes the loan over, and in most cases, if not almost all, those properties are performing worse than even when we had them. Just reality,
Mm.
and now they're going to be stuck. So you look at the maturity, the loans that are happening. It's not really totally accurate because now you have all these new deals that are going to flood the market again, and a lot of those don't qualify for agency debt either. So lenders are forcing people to sell. In a lot of cases, they can't sell even at the note value. So what do you do? It's a total different kind of discussion how you handle that situation. And some deals that can qualify to be able to go into a Fannie or Freddie loan, people are interested in buying those because they think they're getting it at a discount compared to what they will maybe a year from now.
Are there any, because of, you mentioned lenders basically telling operators, hey, sell the deal, even if they had made all of their payments? Are there any newer either products or strategies or even just new lenders that are coming out with different ways for people to take down larger deals? Or is a system like that, where it's of course larger deals, greater risk, is it hard to change, the lending institutions?
There are definitely new lenders coming out. I mean, a lot of them not to be these lenders that are, do a lot of stuff during the cycle, in my opinion, and not friendly lenders, if you want to say. They just fold up shop, open up a new name, and start over again, right? I mean,
Okay.
they just they don't never disappear really. Um, outside of the Fannie Freddie, there's definitely still bridge debt. There bank debt you can get, with a regional bank as an example, but that's going to be usually amortized over like usually 20-year period, full recourse debt, personal liability, things like that. But don't be fooled. The non-recourse debt is not really truly non-recourse either. So don't be fooled by that myth, because
Mm.
lenders do and say whatever they want. But they're definitely lending its way down as far as what they're going to give you for value. Even if you go onto a deal and they say, hey, we're going to give you $10 million a loan, then when you get closer to time frame, they're like,
Yeah.
we're going to give you 9 million. What do you do, right? It's just it's kind of a game.
I don't know the multifamily world on that level, but I know the single family world, and lenders is the same thing. It's like, okay, well, we now need an additional appraisal. We need an additional
Right.
inspection. This came back this. And now, so you're like, we had this deal, everything lined up. And then at the 11th hour, now we need a new lender, basically. I can imagine the frustration on these larger
Oh, yeah.
deals.
When the time frame's longer to close typically on a multifamily. So we have deals where, we're under contract and you don't close for 90 to 120 days in some cases. And the lender's like, well, give us $3 million extra to close the deal. We had a refinance we were doing where, the treasury went up by 50 basis points. So that's just like 0.50%. That sounds really minor and small. Well, on a $20 million refi, that would have required us to bring an additional $1.2 million just by the rate going from, by 50 basis points. It sounds trivial and small. It's not.
Yeah.
And that's all why you're, under either contract or trying to refinance a property. So a lot of things can happen in a pretty short period of time. Rates are more stable now than they have been, for a long time. But we had deals where, under contract rates went up, 250, 300 basis points. So 2.5%, 3% while you're under contract.
Mm.
And you get to make tough decisions. What do? You move forward.
How does that happen?
A lot of the loans you can't lock in. So there are loans in some cases you can lock in, but many of the loans you can't lock in your rate right up front. So
In that 2-month, 3-month period, you could be looking at a totally different
oh yeah,
underwriting.
like millions of dollars of additional capital need to be brought in some cases in those deals.
Okay. I can imagine the complexities there. And, if you're putting something under contract and then, 90, 120 days later, it's an entirely different deal. It's almost like you've got multiple plates spinning in the air on every deal. So
You do.
I can imagine that's challenging if you've got more than a handful of those. We are coming up on time here though, Mark. Where can folks go if they're maybe interested in reaching out to you? Maybe they've got a deal or would just like to learn more about Think Multifamily.
Yeah, our website's thinkmultifamily.com, and then they can also shoot an email to info@thinkmultifamily.com. And reality is there's a lot of things that people should be doing differently going forward. And you mentioned a lot of new people. They don't even know what they don't know yet. And, ideally people can start talking more about some of the issues going on and how to solve those issues now, but also for future deals. That's going to be critical for people to be successful.
Mark, thank you for coming on the show today.
Thanks for having me. I appreciate it.
Thanks for joining us for today's Real Estate Pros Show. You can learn more about the amazing benefits of the Investor Fuel Mastermind community, including surrounding yourself with hundreds of other rock stars, 100% financing for your deals, and members-only discounts from vendors you're likely already using that, as a member of Investor Fuel, will save you more than the cost of your membership. Visit investorfuel.com to learn more. If you're interested in joining us as a guest of this show, please visit investorfuel.com/pros to apply. You can also check the show notes for access to free resources, how to get access to world-class lead generation, and much more. Don't forget to subscribe so you never miss another episode. Have a great day. We'll see you on the next show.